So let's work on the second part of the first chapter of the role of managerial finance. So there are three goals that we're going to discuss in this presentation. First, describe how the managerial finance functions related to economics and accounting. We will also look at and identify the primary activities of the financial manager. Apart from that, we're going to study a little bit about principal and agent relationship. Now, field of finance is closely related to economics. All the assumptions, especially when you are projecting or planning the financial statements, you will require assumptions on things like inflation, interest rates, and foreign exchange, etc. And these all belong to economics. And apart from that, all the country's economic policy, how it affects the businesses, has to be taken into account by the financial managers. So economic theory is very closely related to finance function. For instance, if you look at it, the marginal cost benefit analysis. If we buy a computer um, which will give us a benefit worth of $10,000, and if we sell the old computer for $3,000, the added benefit is $7,000. And then we also look at the cost. So cost of a new computer is 2,000, and marginal added cost is less than has to be less than 6,000. That is the difference between the cost of new computer and proceeds from the sale of the old computer. Then we can use the benefit of 7,000 with the cost of marginal cost of 8,000 and see if it's a positive figure, which you can't see here because of my video, but in the slides available you can see those numbers. You will see the net benefit is positive. That is the marginal cost benefit analysis, which is the economic principle that states that financial decisions should be made and actions taken only when the added benefit exceeds the added cost. So we will always look at this added benefit exceeds the added costs. Now look at the accounting. Accounting is basically, let's look at an example that's much more appropriate. Normally we have the accrual based system in which sales, like in this example, we have $100,000 of sales, which is uncollected, 100% still uncollected. And cost is $80,000, which is fully paid. Now, cash basis versus accounting basis, accrual basis, will have different results. For instance, if you look at this, sales revenue has been booked as full amount at $100,000, while cost is $80,000, and the net profit is $20,000. While if you look at the cash inflow, actually we have received nothing, zero, and cash outflow, which has gone $80,000. So we are at loss of $80,000. Net cash flow is minus $80,000. Now, both views give us different view of the financial status of a firm. Hence, we see that both are connected, and at the same time, it depends on what type of methodology is used. Accountants devote most of their attention to the collection and presentation of financial data, while financial managers evaluate the accounting statement. So they estimate based using ratio analysis, or the other way around, estimating cash flows, free cash flows, estimating the terminal values, and using it in their analysis to make decisions. So finance managers actually rely on what accountants provide them and use them to project these financials of the firm. And you can see this from this graph, which is pretty much obvious. There are investment decision and there are financing decisions, and in a standard balance sheet. So what is invested in current asset, how much invested in fixed assets, gives us an idea of firm's investment strategy, from where to arrange the funds. and from where to arrange the long-term funds. For the fixed assets, we would require the long-term funds. So these are the financing decision, from where the money will come, how to raise the money, by issuing bonds or going to the banks, etc. These are the financial activities uh, linked to the accounting. So balance sheet is basically an accounting statement, while financial activities are linked to it, in a sense that finance manager relies on the statements provided by the accountants. Let's quickly look at governance, corporate governance. Uh, Corporate governance refers to the rules, processes, and laws by which the company are operated and controlled and regulated. If you look at it, we already discussed this hierarchy where we have owners, we have managers, and then we have other managers. The prime difference between owners and managers is that owners have a stake, in a sense that they are going to earn money if managers perform well. So if managers perform well, owners are going to be rich. So managers' performance is linked to the profitability of the business, and so owners are going to hire the managers on terms and conditions, especially the CEO and the CFO, in a sense that the firm share price or its earning per share will increase. If it increases, managers will receive some sort of incentives or compensation, because eventually these strategies that managers are going to employ to increase the EPS or the earnings or the share price will make owners rich. Hence, um, um, there is no problem. However, if managers do not follow to follow and increase the share price or EPS, then there is a problem between owners and managers. Managers will be start working for themselves while owners are without looking at owners' benefit, and this is what we call an agency problem. And this agency problem could be reduced if owners tie the managers' compensation with certain specific and quantitatively known variables, such as earnings, earning per share, or share price. So if share price increases, this means that the firm has created value, managers has created value. If earning per share increases, this means that managers has created value, they have taken decisions which are positive and has increased the value of the firm. So in order to remove these agency problems, uh, owners must tie the compensation of managers uh, uh, with certain financial variables, measurable financial variables, in fact. So uh, this relationship between owners and the managers is called principal um, agent relationship, while the problem between owners and managers is called what we call as agency problem. Arise when managers place personal goals ahead of the goals of the shareholders. And agency cost is, if there is an agency problem, obviously we will have the cost that will be borne by the shareholders or the owners and represents a loss of wealth. So they have to tie up, the owners have to tie up managers' compensation with incentive plans and performance plans so that they can perform. Once they perform, they will get um, certain incentives out of the contract. This includes granting of stock options or the bonuses, etc. Another problem with agency issues is the threat of takeover. So threat of takeover. If when a firm's internal corporate governance structure is unable to keep agency problems in check, it is likely that rival managers will try to gain control of the firm. Now, uh, hence, we do not want this agency problem to be there. So the threat of takeover by another firm which believes it can enhance the troubled firm's value by restructuring its management, operations, and financing can provide a strong source of external corporate governance. So it's also possible that if there is too much of agency problem, and a takeover can actually help the company to remove this agency problem and start flying. So in the first chapter, we have looked at how the managerial finance function is related to economics and accounting, identify the primary activities of the financial manager, describe the nature of the principal agent relationship between the owners and managers of a corporation, and explain how various corporate governance mechanisms attempt to manage agency problem. So I would so thank you very much, and see you for the next chapter.